Welcome, once again, to Customs and GST Advisory Channel of Customs, GST.com. A major judgment has now come from the Gujarat High Court concerning GST on corporate guarantees between holding companies and subsidiaries. The court has delivered substantial relief to taxpayers. It has read down part of Rule 28(2), protected earlier periods, quashed proceedings under Section 74, and directed refund of excess GST in appropriate cases. But when we read the judgment closely, another question arises. Has the judgment itself created certain legal contradictions which may eventually require examination by the Supreme Court? Can a valuation rule create a taxable event? Can the same corporate guarantee simultaneously be a one-time undertaking and also generate a fresh taxable event every year? Can a guarantee executed years earlier suddenly become taxable on 26 October 2023 merely because it continues to exist? Can consideration under the Indian Contract Act automatically become consideration under GST? And can the statutory relationship between a holding company and subsidiary itself create a legal obligation to provide a corporate guarantee? In this video, we examine 10 potential grounds on which this important Gujarat High Court judgment may be tested before the Supreme Court. This is not a prediction of how the Supreme Court will decide. It is an analysis of the statutory questions that may arise in appellate scrutiny. The first and perhaps most fundamental question concerns the architecture of the CGST Act. The statutory sequence is important. First comes Section 7, whether there is a supply. Then Section 9, the levy of GST. Then Section 13, the time of supply. And only thereafter comes Section 15 read, with Rule 28, determination of value. In other words, supply first, taxable event first, valuation later. Rule 28(2) is situated in the valuation machinery. Its expression 1% per annum tells us how the value of a corporate guarantee may be quantified. But can those words themselves create a fresh supply every year? That is the constitutional and statutory question. CBI's own Circular 225 specifically says that Rule 28(2) is only for determining the value of an already taxable supply and not for determining taxability itself. Therefore, one possible Supreme Court question could be, can subordinate valuation legislation be used backwards to manufacture a taxable event which the charging provisions themselves do not independently create? The second ground emerges from the judgment's own reasoning. The court observes that the corporate guarantee crystallizes upon execution. It further says that actual payment by the guarantor after default does not create a new taxable service. It merely fulfills the existing guarantee. Then comes another important finding. The court holds that a corporate guarantee is not a continuous supply of services under Section 233, because the essential element of periodic payment obligations is absent. It describes the guarantee, in substance, as a one-time undertaking with a continuing obligation, but the judgment then reasons that because the guarantee continues to be reflected in the subsidiary's books, the time of supply can arise every year, and the outstanding guaranteed amount becomes the basis for annual tax consequences. That creates a difficult question. If there is one undertaking, one execution, no continuous supply and no fresh annual agreement, where does the new annual supply come from? A continuing legal consequence is not necessarily a recurring taxable event, and an annual accounting disclosure is not necessarily an annual supply. This takes us to the third question. Section 13 is a time of supply provision. It answers, when did an existing supply occur? It ordinarily does not answer, did a supply exist in the first place? The Gujarat High Court relies significantly upon Section 13(2), which refers to the date on which the recipient records receipt of services in its books, where the preceding clauses do not apply. But an accounting entry should ordinarily determine the timing of an existing taxable transaction. The deeper question is whether the same accounting entry can create an entirely new supply every financial year. Suppose a guarantee was executed once for 5 years. Recording its outstanding exposure every year may satisfy accounting disclosure requirements. but accounting recognition and taxable supply are not necessarily identical legal concepts. This may therefore become a major Supreme Court question. Can Section 13 determine when a supply occurs, or can it also create repeated supplies which Section 7 has never independently created? The fourth ground may become extremely important for old corporate guarantees. The operative conclusion says that Rule 28(2) cannot be used to impose GST for the period before 26 October 2023. But it further says that the levy gets attracted from 26 October 2023 if the guarantee continues. Consider this example. A corporate guarantee was executed in 2021. Its contractual term runs until 2027. Nothing happens on 26 October 2023. There is no fresh guarantee, no renewal, no modification, no fresh consideration, and no fresh contractual undertaking. Only the valuation rule changes. What taxable event occurs on that date? CBIC Circular 225 draws a materially different dividing line. It says guarantees issued or renewed before 26 October 2023 are valued under the earlier Rule 28, while guarantees issued or renewed on or after 26 October 23 are valued under Rule 28. It also says even a loan takeover has no fresh GST consequence unless accompanied by a fresh or renewed corporate guarantee. That gives rise to a powerful question. Can mere continuation of an old contract attract a new valuation regime without any fresh taxable event? Ground number 5 produces another apparent contradiction. The High Court reasons that taxing earlier guarantees through the new 1% mechanism would amount to an impermissible retrospective or retroactive burden, and states that revenue had no legal basis or authority to levy GST on corporate guarantees executed before introduction of Rule 28, but elsewhere, the judgment accepts that related person corporate guarantees can constitute supply under Section 7(1). C. Read with Schedule I. If the supply already existed under Section 7, the charging provision under Section 9 also already existed. And before Rule 28(2), Rule 28 itself contained valuation machinery, followed where necessary by Rules 30 and 31. Indeed, Circular 225 takes precisely this position. Corporate guarantees were taxable, even before Rule 28(2), while the earlier version of Rule 28 governed valuation. Therefore, there are actually two different propositions. 1. The new 1% formula cannot retrospectively value an old completed supply. And 2. There was no taxable supply at all before 26 October 2023. Those propositions are not the same. The Supreme Court may have to determine which is legally correct. Ground number 6 concerns the concept of consideration. Section 127 of the Indian Contract Act provides that anything done or any promise made for the benefit of the principal debtor may constitute sufficient consideration for the surety giving the guarantee. That principle answers an important contract law question. Is the guarantee legally enforceable? But G asks a different question. The CGST Act contains its own statutory concept of consideration. The real inquiry should therefore be, was something paid, promised, done, or foregone in respect of, in response to, or for inducing the alleged supply? The Gujarat High Court reasons that the loan advanced by the creditor bank for the subsidiary provides the necessary consideration to the holding company under Section 127 of the Contract Act. The judgment even refers in this context to Section 2(102) of the CG Act, although Section 2(102) deals with services, not the statutory definition of consideration. Deals with service. This may therefore be tested before the Supreme Court. Can consideration sufficient to support a contract under Section 127 of the Contract Act automatically be treated as consideration for a taxable supply under GST? Ground number 7 follows naturally. The statutory distinction under Section 7 is critical. Section 7(1)(a) covers ordinary supplies for consideration in the course or furtherance of business. Section 7(1) C specifically brings Schedule I activities within supply, even without consideration. The judgment repeatedly treats corporate guarantees between related persons without consideration as covered by Section 7(1)(c), but at one point after discussing consideration under the Contract Act, the judgment states that execution of corporate guarantee without consideration satisfies Section 7(1)(a). Read with Schedule I. This may simply be a drafting error, but the conceptual distinction matters. If GST consideration exists, the analysis may proceed under Section 7(1)(a). If there is no GST consideration, revenue must justify the transaction under Section 7(1)(c) and Schedule I. The two routes should not be blended together because each has different Ground number 8 may be one of the most interesting questions in the entire judgment. For Schedule 2, Entry 5(e), the court examines the expression, agreeing to the obligation to do an act. The court then observes that because the holding company and subsidiary relationship is recognized under Section 287 of the Companies Act, there exists a legal tie vinculum juris, and proceeds to state that the holding company is bound by a legal duty to do or not to do something for the subsidiary. From this, it connects the corporate guarantee with the expression agreeing to the obligation to do an act. But here lies the appellate question. Section 287 of the Companies Act primarily identifies what constitutes a subsidiary company. Does that definition itself impose a statutory duty upon a holding company to guarantee the subsidiary's bank borrowings? Ordinarily, a parent company does not automatically become legally bound to discharge every debt of its subsidiary merely because of the corporate relationship. The guarantee becomes binding because the parent chooses to execute the guarantee. Therefore, the Supreme Court may ask, is the relevant obligation created by the Companies Act relationship or by the separate guarantee contract itself? And if every contractual promise to do something automatically falls within Schedule 2 Entry 5, does that provision become virtually unlimited? Ground number 9 concerns the identity of the recipient. A corporate guarantee is normally executed by the surety in favor of the creditor bank. The bank receives the enforceable promise. The subsidiary undoubtedly receives an economic benefit because the guarantee facilitates its borrowing. The Gujarat High Court holds that the subsidiary is the recipient because the service ultimately accrues to and benefits the subsidiary, and because Sections 140 and 145 of the Contract Act create rights of subrogation and indemnification between surety and principal debtor. But Section 293(c), in a case without consideration, asks who is the person to whom the service is rendered. That raises a potentially important distinction. Beneficiary of an arrangement is not automatically identical to recipient of the alleged service. The Supreme Court may therefore have to examine the triangular relationship carefully. Between holding company and bank gives loan to subsidiary. Subsidiary is the commercial beneficiary. The question is not whether the subsidiary benefits. It clearly does. The question is, to whom is the alleged guarantee service legally rendered? Our 10th ground concerns the court's important relief regarding valuation. Rule 28(2) stated that value would be 1% per annum of the guarantee amount or actual consideration, whichever is higher. The High Court finds the words whichever is higher arbitrary and reads them down, while keeping the rest of Rule 28(2) valid. This gives genuine taxpayer relief, but another legal question follows. After removing whichever is higher, the provision effectively says 1% per annum or actual consideration. Which one applies? Suppose actual commission is 0.25%. Can the taxpayer select 0.25%? Suppose it is 1.50%. Can the taxpayer still select 1%? Suppose no commission exists. Does 1% automatically apply? The judgment appears to intend that actual ascertainable consideration should prevail, and 1% should operate where actual value cannot appropriately be determined. But is that merely interpretation? Or has the court effectively supplied an option and valuation mechanism, not actually written into Rule 28(2)? This raises the classic constitutional distinction between reading down a provision to save it and rewriting delegated legislation. That issue, too, may eventually require Supreme Court clarification. At this point, one clarification is essential. These 10 grounds do not mean that the entire Gujarat High Court judgment is legally unsustainable. Several parts of the judgment may prove considerably stronger. The proposition that transactions between related persons can fall within schedule, i.e. even without consideration, has substantial statutory support. The court's reluctance to permit a mechanically higher 1% valuation, where genuine actual commission is ascertainable, raises a serious constitutional valuation question, and its finding that Section 74 cannot casually be invoked without material supporting fraud, willful misstatement, or suppression with intent to evade tax is a separate and significant protection for taxpayers. The court ultimately quashed the impugned Section 74 proceedings and directed refund or adjustment of excess amounts. Therefore, the likely Supreme Court debate, if the matter reaches that stage, may not be, is the entire judgment right or wrong? The more sophisticated question may be, which propositions survive and which propositions require correction or reconciliation with the statutory architecture. If we reduce the entire controversy to 4 fundamental questions, they are these. Question number 1, can a valuation rule create the taxable event? Question number 2, can one corporate guarantee be treated as a one-time undertaking, not a continuous supply, but nevertheless generate a taxable event every year? And question number 4, can concepts borrowed from contract law, company law, and accounting standards replace the specific statutory ingredients prescribed by Sections 2, 7, 13, and 15 of the GST Act? These questions go much beyond corporate guarantees. They involve a fundamental principle of tax jurisprudence. The taxable event must come from the charging statute. The time provision can locate it, the valuation provision can quantify it, but neither timing nor valuation should ordinarily manufacture the taxable event itself. That may ultimately become the central issue if this judgment reaches the Supreme Court. Thank you for watching Customs and GST Advisory channel of the Customs, GST.com. The Gujarat High Court judgment is undoubtedly an important development in the law relating to GST on corporate guarantees. But important judgments often raise equally important questions. Whether these questions ultimately reach the Supreme Court and how the Supreme Court reconciles Sections 7, 13, and 15 with Rule 28(2) could shape the GST treatment of corporate guarantees across India. Please share your views in the comments. Do you believe that a corporate guarantee is one supply at execution? Or do you believe that the guarantee creates a fresh taxable event every year during its currency? If you found this analysis useful, please like, share, and subscribe, press the bell icon, and visit CustomsGS.com for further resolution of customs, GST, and indirect tax litigation.